Exchange-traded funds, they are companies that create baskets of stocks or leveraged instruments, futures, to mirror a particular trading vehicle that's already out there. When I say vehicle, that could be anything as simple as a fund that trades a stock versus, or that mimics a stock, or a fund all the way that mimics the entire US market, for example. The reason these were introduced was in order for us to spread risk, was the very first reason. Exchange-traded funds, for example, on a sector, for example, say the finance sector. If instead of buying a stock within the finance sector, like a bank, for example, in being able to participate in the movements in the banking sector, rather than buying all the stocks in that sector or in the subsectors, you could buy an exchange-traded fund, which is one ticker that was designed by the creators of that fund to mimic that particular sector and actually move when that sector moves as well. This also has the added advantage, especially at that sector level, of spreading risk for you in a position. Rather than buying one particular bank, for example, if you've done your analysis to buy, you could instead buy an entire sector of the market, in this case the banking sector, for example, and that spreads the risk rather than being in one particular stock. So that's kind of the founding sort of reason for exchange-traded funds. It was also a part of a possibility of finding funds and making funds that were less expensive to buy than trying to buy, say, an index fund or something that was currently trading at hundreds and hundreds of dollars. Creating an exchange-traded fund that moved in the same fashion but was less expensive was also very attractive to traders like us. So on this particular page here, this is the Direxion ETFs, and this is the fund family we're going to look at in this session. I selected, as I say, one fund family. There are many, many more. And I'm going to briefly just talk through what these different fund types they have in there. And I'll show you what we've done and what I'm going to make available for you so you can have the lists of these funds in your system as well. Number one, diversity is a big thing. This allows us, that's why this session is ETFs to trade everything. Literally, in this one fund family, you can trade pretty much anything. When I say anything, it's different markets, whether it's individual stocks that are mirrored by the fund or leveraged, whether it's bonds, whether it's entire markets, whether it's international markets, and there's even some that do currencies. And of course, the one that I find the most useful are the funds that match the different sectors of the market. That allows me to buy an entire sector. So let's go through this list real quick, and then I'll get into the charts and we'll look at some of the analysis we can do, and you'll see exactly how useful this can be for our trading. So for a start, let's scroll down to this first one here, single stock exchange traded funds. So these are funds that mirror the stocks that they're designed to mirror. Only a handful of these, obviously very, very well-known big stocks, Google, Amazon, Apple, Microsoft, and Tesla are in here. The great thing about this is that you've got long and short. So you have the ability here to buy, for example, if your analysis was to say Apple was likely to go down, or that came up in one of our reports, or in the EDS, one of the bearish candlestick strategies, for example, that Darren uses. Instead of going short the stock, which requires us to borrow the stock from a broker, and then there are fees involved in that, and you also then have to sell the stock and buy it back later, hopefully at a cheaper price, and give it back to the broker and pocket the difference. That's a more complex trading approach, and it also requires a margin account in order for you to cover that, because you're selling stocks that aren't yours. With something like these single stock exchange traded funds, you can see in that list there, with Apple on the bullish side, there's one that goes up 1.5 times what Apple does. So if Apple goes up $5, this goes up 7.5. On the flip side, the top one there, the AAPD, this is the bearish one. So as I'm saying, if you've got a bearish indication on Apple, instead of having to sell short, you buy that particular exchange traded fund. And what does it do? It exactly does the opposite of what goes on with the direction of Apple. Let me just show you that real quick so that you can see the concept behind that. If we look at a chart of Apple versus the AAPD, the inverse of that. So I'll bring up Apple and put it on the chart. And then we'll overlay AAPD. Now, it's not been trading that long, so I won't fill the whole chart up here. But I will actually on this one. But look at that. You can see that I've illustrated this before if you've seen any of my exchange traded fund sessions. If I draw a nice line right down through the middle here, and already there, give me a second. There. Right through the middle, you can see it's like a mirror. It's a complete mirror, complete opposite. So when you get a sell signal, or say go short signal, say on Apple, then you flip around and buy this exchange traded fund, which does that exactly the opposite. It's a really, really easy way to play both long and short side. There's the other ETF that goes 1.5 times Apple for the long side. On the short side, you buy this, and look at the price of it. It's in the 20s, so it's not as expensive as Apple is. So that's a great illustration of of why those ETFs are so useful for us to play those particular stocks in both directions. So again, there's similar ones here for all of the others. There's Amazon, Google, there's Microsoft, and of course there's Tesla as well now. All the very popular ones. Next area is fixed income. Less interesting for most of us trading, because these are fixed incomes are somewhat slow movers. 20-year bond, 7 to 10-year bond. But the interesting thing here becomes more interesting, because instead of staying with the sort of incremental movements you get on bonds when interest rates change, here you've got the triple. So they're 3 times both the bearish and the bullish. So in both cases here, you're seeing when a bond moves up by 1%, which is a pretty good move, these move up by 3%. So there's again a lot more volatility because of the sheer amount of leverage that's involved in the actual ETF. But you don't need leverage to buy these. So you can be either side of whether the bond are moving up or moving down. You can just buy the most appropriate exchange traded fund. The next level down here is the international equity. So this is funds that mirror these major market indexes, like the Chinese. There's also the Korean, there's a Mexican, and then there's one for the entire emerging market. Now, some of these are not trading as heavily as we like liquidity-wise, so some of these I culled out, and that's a big consideration. We don't buy or trade, low liquidity, because the bid and ask spread, that's the spread between what you buy and what you sell at, can be so wide you're immediately in the hole as soon as you buy a position, and it's hard to get it in and out if there's no liquidity. So we put some of those in there too. And the next one down, probably the most popular exchange traded funds are market caps. So there's many of these through all of the different fund companies that are available. In Direxions, we're looking at the S&P 500 bear and bullish 3 times, and also looking at they have the Direxion small cap bear and bullish 3 times. Those are both very powerful and well traded, and then the mid cap is just the bullish one. Those 5 are very heavily traded and very easy to get in and out of. And you can see in this list here, by the way, just go to Direxions.com/ETFs. You can see the index, the ticker, the market. It's designed to mirror, and also the amount it's time to buy. It's leveraged amount. So in the case with the Russell 2000 index here, when it goes down 2%, this particular ETF will go up 6%, because it's so bearish. It's designed to do the inverse of what the Russell is doing. But very useful, very easy, for us to take advantage of whatever direction markets are going, and also get more bang out of our money, because you're not just waiting for the market to move 1 or 2%. When that happens, these move 3 times that amount. Next area down here, sector equity, very, very powerful again. The power of your WinWave TradingExpert Pro with the analysis we do on group and sector rotation as a start point for us to drill down into the stock level to find candidate stocks within groups and sectors. This is another way of taking advantage of rotation from one segment of the market to the other. Instead of buying a stock within a group which is in a sector, in here you can buy entire sectors, and this mirrors quite closely, in this case, more often than not, a major sector index that's published out there. For example, like the Dow Jones Internet Composite Index, which has this ticker here. So there's a 3 times bullish on that one. There are bullish and bearish on the financial, which is very useful. We'll look at that at the moment, because this was a great area to look at earlier this year. And so again, we've got ability here to go long or go short by just buying an ETF that matches a particular sector. So in a case like this, when the financial sector took a hit earlier this year, you could have gone into the daily financial bullish 3 times Direxion, and when that, the bearish direction. So when the financial sector went down, stocks in the banking sector took a hit at that time, then you could be gaining 3 times the move to the downside by buying FAZ, a very, very popular exchange traded fund for mirroring when the market in the financial sector goes down. So again, fair few of those in there. Added most of those into a list, which I'll show you in a little bit. And finally here we have a sort of a conglomeration of things that match commodities, but also match particular other indexes that are out there in the world, so they don't have a sort of home for their own, for example. So here you can trade gold long and short. You can be either side, whether it's gold miners or gold index. Here you can trade the Brazilian index. There's also FANG stocks, which are down here. There's indexes that are mirrored in these ETFs for various different areas. And most of these, again, almost all of these are leveraged. Some of these are a little more esoteric, and I checked all these out. Some of them I didn't keep in the system because there's just not enough trading among them. It's not many. Many of these trade huge amounts of volume. But things like Direxion, Daily Travel and Vacation, Bullish 2X, it's a little esoteric for me, and when I looked at it, it's not trading enough. So that's the overview. Let's go in and have a look at what we've done here. I'm going to show you in the data manager. So first thing is I would be sharing with you is Direxion's list. It's a linear list of all the tickers that we were just looking at on that page, minus about 6 or 7 that I consider not to be liquid enough for us to be interested. All the rest have great liquidity. I then broke them down into several lists, just like it was on that web page. So Direxion's 2 times ETFs, which was the last section we looked at, fixed income, international equity, market cap, and then we have the sector, and then the non-leveraged ones, which are just straight 1-to-1. If it goes up 1% on the one sector it's following, or the stock, it goes up 1% on the ETF. And finally, the one for just the stocks, like that Apple. So it's all broken down nice and easily, so that ETF for the stocks you see there, we looked at this a moment ago. Those are in lists, easy for you to actually just scroll through in the charting area if you just want to have a look at those particular ETFs and how they're doing. Let's take a look at something that happened, for example, back in the banking sector. That was a big thing. Banks, we know what happened with the banks, especially Silicon Valley Bank and New York Bank as well. And when that particular issue blew up, banks were already fairly falling down, onto the downside. There was a lot of pressure, but things were still holding up fairly well. So something you could do, as I say, to take advantage of the sectors and what they're doing, but using ETFs in replacement for stocks, is literally to come into the reports themselves, but you'd go to global properties and you pick the DX sector. So what you'll be doing here is on the stock reports in here is you're running all of those great reports, but just on the sector ETFs. So it's a short list, makes our life a little easier. We like short lists. And that's what I did here. And for this illustration, I wanted to show you exactly how this sort of rotation can be seen even in the regular stock reports here. And the best way to look at this is by looking at like the relative strength strong here, for example. So what I did was I ran this on March the 7th. And I chose this date because it's just before the fall down in the financial stocks in the banking sector themselves. So let's go and look at relative strength short-term weak, and then relative strength short-term long. So you have all of these reports in here, which will tell us which of these are the weakest. The ones at the top are the most weak, and the ones at the bottom are the least weak, I guess is the way to look at it. So in here, when we go into the strong one here, look at this particular situation. Relative strength is a measure of a movement of an exchange-traded fund, in this case, or a stock against its own price. Gives you kind of like a slope, is kind of that relative strength ranking. And it's ranked against the other tickers. So when you see this ticker here, WEBL, this ticker on 3.7, when I double-click it, on 3.7, back here, relative strength indicates that this is likely to be a good ticker to go into, and it went up fairly well there. But at the same time on 3.7, when you look at something like this, the Direxion's Financial Bullish 3X, and we'll dump that one into the charts instead. On 3.7, this is doing a pretty bad thing overall. So 3.7, this is when this report was generated on this particular day. It's the bottom of the relative strength. It's beginning to go down. And it began to accelerate all the way down from there. So you could see how bad the financial sector was. So it's the bottom of the relative strength. What would you do to take advantage of that? You trade the FAZ. So let me bring up the FAZ on its own. Look at that. That's how you take advantage of a weak sector, is to buy its inverse. And this ETF, I mean, this signal, this was the bottom of that report. If you got in here the next morning, around about opened at 1801, and within 7 to 8 days, it's moved up to 24 or 25. That's it's like a 30% move in a very short period of time, and that's far more than the banking sector itself moved, and it's far more, of course, than individual stocks moved, except for those that got totally hammered. And of course, that regional banking is what drove this whole move. That regional banking breakdown on just those smaller banks caused that to happen. So that's how you take advantage with actually outbuying a stock, without buying a stock. And you get the leverage in here as well. So we know that from that period here, though it moved up 30% for this bearish fund, we know that the actual banking sector itself only moved 10%, still a pretty big move, but to the downside of it, because we're looking at here. So it's a pretty good instrument to trade those sort of situations. We go back into the reports here again. I was saying here, relative strength ranking is one way of looking at things here. We can also look at those that are on like a price gap. Actually, the best one I think in here is the price change, the upside or the downside. This gives us an idea of which of the ETFs that we're looking at are moving up or down. So in the short term, remember we did this on 3.7, so we know that on that day, this is the real estate bearish 3X had a major move and is still moving. It's the top ticker in this report. So this is a pretty good stock. So we've been in 3.7. So when we go back to 3.7, and remember this is price change. The reason it was top of the report was this here. This got it to the top because it had a great price change, and the continuation of that price change kept going. 3 times, remember, this is a 3 times ETF. So with this being the top of the report, the best candidate, you could have got in at the open on 38 to around about 49. Look how far it went up to close to 64. And you're talking about 15-point move within, what is that, 2, 4, 6, 8, 10 days, 10 trading days. Again, that's a pretty good move. And it's because it's 3 times. It's the leverage is 3 times. One quick check on the volume. Just want to let you know the volume itself. Volume is great. I mean, this is in thousands, so this is 593,000 shares traded that day. No problem getting into that at all. Really isn't. So again, that's just taking those sectors, those sector ETFs, and just putting them into reports themselves. You could, again, the analysis is I'm just trying to make my life easier. I could have done this, and I'll do this right now, which is go to global properties and just use the entire directions. So this gives me everything that's in that particular list. So I could get a global market, an international market, FANG stock, fixed income, single stock. It doesn't matter. It doesn't matter because I'm going to allow the reports to tell me what's the best place to be. So if I do this again and we generate that, so I've changed it to the bigger list, I'll generate them all for, we'll go back and do the same data again just so we can see that. And off it goes, running through. You notice right now it's this is just the stock reports are changing there. The global properties, the group and sector reports are still on the S&P 500. So we have the ability to even look at the S&P 500 groups and sectors just to see if those are performing well or which ones are performing well, and then matching those up to the ETFs themselves. So you notice we were on the price change upside short term. Now we have a bigger list of stocks to look at in here. You notice the Directions Daily Real Estate Bearish 3X is still at the top there. Next one down, though, this is a new one because we've got a wider list to look at. This is the gold miners. So when we look at the gold miners, what happened there? Price change to the upside was over here. That's what got it on the list. 3.7 got us to here. Didn't go up very far from there. You'd have probably been out of the position for a small loss on that one. We don't always win them all. Price change to the upside on this one here. This one is much better. So here you're getting at 3 point. This is Directions shares daily S&P 500. So this one have moved from 4.81 up to 6.06. Now, doesn't seem a lot in the grand scheme of things for a move, but actually it's a pretty good move. 4.81 to 6.06. You're talking about what is that? 1.25. That's 25% move. So pretty good again. With good stocks, we get knocked out of the ones that don't work in our favor, and we stay in the ones that do work in our favor. So that's got the whole list of those ETFs in here. As you can see here, we've got everything from financial bearish 3X, not surprising. That's had a good short-term price change given the fall down in the financial stocks. And of course, as you move down, these one it gets less and less as you get down the list here. It doesn't matter because it's telling us which stocks which ETFs are the best place to be in. As I mentioned, in the group reports are still generated in here based upon the S&P 500. So on 3.7, you have here an aerospace and defense is still the top group up here. So you could actually look and say, okay, that's a very strong performing group at the moment. I can go and find the closest ETF, if there is one, to that particular group. Again, not all of these sectors have ETFs within this Directions family, but I can tell you there are ETFs out there. If you're expanding a universe of ETFs to match that entire group area. So let's go and have a quick look here. One thing I wanted to show you was the EDS self-exchange at the Expert Design Studio. Earlier, Ray showed you and mentioned one of Darren's reports, which was the Winway 3 favorite bullish and bearish candlesticks patterns. So in this particular report, I opened up the exchange, the EDS, and changed the properties in here. Again, remember, we're doing this to just squeeze down our universe a bit. And here I put in the entire directions list that we just looked at in the reports, and I ran it into the candlestick through bearish and bullish. So I ran that for, this one was in on 4-5. Let's just run it on 3-7 because that was where we were running the others. And of course, you can run this every night and run as many of these on as many lists as you wish. But let's change the date on that, and we'll just run them all. You can see it running down the bottom of the screen there through all the lists, just waiting for the ones that are actually meet the criteria. So let's see, out of that Direxion list, these are the tickers that actually fell and met any of these criteria in here as far as categories. So, for example, the Harami bullish, which is a pretty good strategy, TMF was 3-7. So when I double click on this one, TMF, which is the Direxion's daily 20-year Treasury bill, but remember it's 3 times. So Treasury bills, you can see, don't really move huge amount, but on this chart they move fairly well. So this was run on 3-7. You'd have got in at the open on 809. Within 4 days, we were at 9.49 and 9.71. So this moved substantially in several days, just from that entry point. So 8.09 up to the high 9.49. So it moved 1.4 in what, 4 days. 1.4 points. That's a pretty good move, especially in bonds. You cannot make that money in bonds really that easily. But with this 3 times Treasury bill, works pretty good. And that's the Harami that was run on that day, this Harami here. I won't go into explaining the candlestick pattern today. We're just focusing on getting the ETFs and making it all work. This is exactly what you want to see. You want to see an easy way to take advantage of a movement in something like bonds that you would never normally look at, but you can trade it using these. So again, I'm just looking at these. I've just generated this. So this is another bullish one, MSFD. I don't know what it is. I don't remember, but I'll tell you what it is in here. This one is Direxion's Microsoft Bear 1 time. So this is an interesting one. You would have got in here at 23.68, moved up to, well, I didn't really move up much at all. You'd have probably got knocked out for a small loss on that one. As we say, we don't win the war. Engulfing, piercing, bullish, none in there. Now let's have a look at the bearish. I saw one in here, BRZU. So this was a bearish pattern, and let's have a look at that. So BRZ is the Brazilian market, bull 3 times. Unfortunately, there's no bear for us to look at on this one. So this was actually a nice. The signal was here. You would have gone short, or if there was a Brazilian market bear 3x, it would have gone up the same amount as this has gone down. So that's, I'll trade that one particularly well. And TMV, this one is going down. I just want to check this out. 20-year plus Treasury, again, that's just a straightforward one. It did go down again. This one felt pretty good as well. But you'd have to go short on this because there's no reverse one to go to the upside, if that makes sense. Because remember, this is bearish patterns. So I'm looking for it to go. I need something to go in the inverse direction if I'm going to buy something. So really, the bullish ones are the better ones to look at in this particular strategy because we're buying. When you think about it, I could be bearish on something, but be buying an ETF in here. Why? Because it doesn't matter. It just looks at the chart. It just looks to see what's happening. Is this candlestick pattern in place? If it is, that's fine. Then I get to go into that particular ticker, and then I can buy that ETF. And if it's the inverse of something else in the market, that's great. This way, I don't have to worry about it. I just let the system show me what it is that what is going. So let's have a quick look in here at these lists again, just so you can see, get enough feel for what these are. I mentioned the 2x and the 3x. The fixed income, we just saw that a couple of those that came up in there. The market cap ones are the ones I want to look at now. And let's shut this one out. Hit enter. So the market caps in here, the bullish 3. Let's look at this one here. This is very well known. The Direxion's large cap bull 3x versus the Direxion's large cap bear 3x. And look at those two. See, they're the complete inverse of each other. If we go with the large cap bear and overlay this with S&P 500, for example, oops, wrong button. If we chart and then we overlay and we put on here, I'll use an exchange traded fund that mirrors the S&P 500, so that's the SPY, and we'll overlay that. Look at that again. You can see that's just one of my trend lines here. Get rid of that. We can. Oh, we'll come back. So let's just draw another trend line on here, just so we can see this mirror in action. I mean, it's obvious here that, so you have in the yellow the daily cap, large cap bear 3x. So when the market goes down and the S&P goes down 1%, this goes down, this goes up 3%. Remember that. So when the market goes down 1%, the bearish 3 times ETF goes up 3%. And you can see how closely they do mirror each other. So in a case when the market is going down, for example, let's just get rid of the overlay. It's a little remove overlay. So for example, SPXS. So when the market here at the beginning of February began to fall down, which it did, from that moment there, you could have got in at 17 and change and ridden this first part of the move to the downside of the market all the way up to 20 plus. So again, that's a pretty good move right there across that period. And that's because you got 3 times the leverage that you do on the SPY. So the SPY itself, and I'm going to put this next door to it so we can see this illustrated. So during this period, so let's look in here. When you look at the spider, for example, let's go back to just down here a little bit. Press the time frame. Yeah, that's probably the better way of doing it. So in the case here where we're looking, let's do tile vertical. Much prefer. And there we go. And decrease my spacing. Right, so as we're saying here, the Direxion's ETF in February here, went from around about 17 or so all the way up to 19 and change over here, beginning of February. During that time, the S&P, or Spider in this case, mirroring the SPY, like here is this S&P 500, it's gone from 417 down to a sort of a 403 here. It eventually went all the way down to a level of about 380. Look what happened with the SPXS, because it's 3 times the leverage. It went all the way from 16, say call it 17, all the way up to 22.5. So you're talking about 5.5 points on a $17 ETF. I mean, we're really talking about 30% move within that. And you're taking advantage of the market that moved down by about 9-10%. That's the power of those inverse ETFs. And that's the great thing about having that as a separate list that you can analyze. There's no reason not to do your regular analysis with stocks and then switching over like I did by changing that in the reports. And you can go back and review this particular segment when we send out the recording. And as I said, I will make available to you the ETF lists that are in here that I've created and any of the tickers that you may not have in your existing database. I've already done the legwork as far as removing any of the low volume ETFs that are out there. As I say, some of them are pretty unusual, but some of them are fairly young. If we switch over to the stock ones again, the Direxions, let's go into the equity ones. Close out these other guys, and we'll just stick with that. Well, that's international. I don't want international. I wanted the Direxion stock. There you have. So there's Apple. Get rid of this. Get rid of that. Press this in. So there's good history on a large number of these ETFs out there. Notice, like on this one, Direxion's daily Amazon bear one time, so complete inverse of what Amazon does. This one's fairly recent history, as you can see back here, but that's enough for our means. And again, remember I said about the volume. The volume's pretty good. There's spikes in volume days where we're up to 25, 30,000, 50,000. So it's got a decent volume, not a huge amount. So it's fairly early in the world for that particular ETF. Direxion's daily Amazon bullish 1.5. This one's got a lot more volume trading, 167,000, 150,000 a day. So again, if you want to trade Amazon, you don't want to pay the price that Amazon trades at. You buy this instead, and if Amazon goes up, this goes up 1.5 times that amount. Next one here is the Google one. This Google one's this is the 1.5 times bullish on Google. Fairly recent history start on this one too. Nice, reasonable volume. Again, not huge amounts, but enough liquidity for us to have a good bid and ask trade. And again, these are the others that are in there. The volume is modest on these, and as I say, reasonably short history because they've only been out for a little while. So bear that in mind. The Direxions I wanted to look at. One last thing to wrap this up is on the international ones, and so international equity. Some of those I had in there, I removed, so you won't see them in here. The emerging market one here is pretty good. Volume on it is pretty decent as well, 60 to 100,000 a day. And here we have Direxion's daily emerging market and Direxion's daily European bullish 3x market. So when the European market's put up 3 times, they go up, this goes up 3 times. So again, these are, I'm not sure why the Korean market was one they selected, but they did. So that one again, 3x moves the marketplace. The sector ones, the thing about the sector ones, they're fairly well traded because obviously they do follow sectors fairly closely. So bring that back up here. There we go. So Direxion on sectors. Let's get rid of this one. Get rid of this one. So, for example, the real estate bullish and bearish 3x, those are very, very popular. And let's go down daily industrials. So it's like the Dow Industrials, looks just like it, but 3 times. So it goes up 3 times bullish. And then this Direxion financial bullish 3 times. Of course, that took a big hit. You wouldn't be in that for that fall down in the financial sector. This was the one you would be in, which is the reverse of it. So again, you have technology down here. I think this is one of the Direxion's daily tech stocks. It's not leverage; it's just a one-time. But if you want to do the opposite of that, you've got that one there. Direxion's daily transportation bullish. There's no inverse on that one. Daily utilities bullish 3 times. So these are all sort of segment areas that you can analyze just like you do a regular stock. And again, you're buying something that has less risk involved as far as an individual stock, going out of business. That's one of those things, or not just going out of business, but dropping precipitously, like the regional banks did. We just pop back into that real quick, just to illustrate that to you. The SP5. Let's see here. Let's go into the group. So we switched to a group structure that Ray showed earlier, the group structure in here. When I'm in this view here, what I can do is I can go and just find my way around the financial sector. So here's the financial sector here. Remember the big four here? We can see it in here. But there's varying degrees of difference between what's going on in each of the segments of that sector. So the asset management custody banks didn't fall as badly, whereas the investment banking and brokerage came down pretty badly. Goldman Sachs and those guys. The regional banks took the big hit, right? We know those are the guys that took the big hit. And so if you're in one of these regional banks at that time, like the Silicon Valley Bank shares, I mean, look what happened with this thing. It just like it ceased trading down. It took, basically paused trading on it. That's the danger of owning an individual stock. If you happen to be in just the banking sector or this particular group, regional banks itself, you still took a hit. I mean, look how far it fell down. When you get to the sector level, the hit's not quite as bad, but it's still pretty bad. That one segment was sort of precipitated the fall in the others as well. So we can get that effect by buying those ETFs that would do the reverse of that. It does the reverse of what happened with Silicon Valley Bank shares. The other, I don't know if the New York one was in here. Zions Bank or no, I don't think so. No, I don't think that was in there. But remember, this is the S&P 500, the Standard & Poor's 500, the top capitalized stocks in the US market. Nothing's safe. This stuff happens. That's what happens. Bank share, Silicon Valley Bank share, gone. Just like that. And that's simply, again, we can avoid some of that risk by being in exchange-traded funds and taking advantage of buying these ETFs. No matter what the markets do, we can always find something long and something short. I will, as I said, share with you the lists here and the extra tickers that you'll need if you want to run through some of what we're doing here.